While the S&P took off early for a nice long summer weekend, not everything was so quiet. There was some pretty interesting moves today from an inter-market relation standpoint that has some pretty important ramifications about our expectations going forward into the end of the year. So we're going to break those down, what they mean about what we think stocks will do, and what stocks will do better than others based on these intermarket patterns, with a trade idea today of how we can go ahead and start taking advantage of it right now. So that's all the things we're going to cover in this weekend's video. So let's go ahead and get started. Today is Friday, June the 21st, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off our video here looking at the market forecast on the S&P 500, as we always do. Very small trading range today. We've had a nice week, so not too surprising that we don't slow it down here at the end of the day. One of the rare down days on a Friday in this particular calendar year. Obviously going into options expiration. We'll see how bearish we are coming out of options expiration, as we've seen some of these others, even sometimes just going flat, but usually kind of bullish. We've had nice, good bullish runs into all of these recent options expiration cycles. Even when we were bearish, we had a bullish little rally the week of options expiration. And then now we'll see if we don't get, even if we just get sideways weakness, enough to keep that near-term line in there. Now keep in mind, there is that near-term divergence, that bearish divergence there. The blue line giving us lower highs, and the index itself obviously giving us higher highs. So, but also remember too that we got the near-term line above 80. That's necessary for a bullish trend. We got 1, 2, 3, 4, 5, 6 days now above 50 on the near-term line, and we need one more to meet that 7 to 12 day mark. So, yeah, a little bit of weakness. As long as we don't cross below this 287 level, again, sorry, this level right here, 28, about 28.75. As long as we hold above that and any kind of near-term weakness, then we're fine. Like breaking below that, then you have problems, right, in terms of the bearish divergence leading to a trend change. Obviously, it would be a bearish trend. And that's not expected. I expect that we might get a little bit of weakness down into this area. Probably down towards that 292.50 area on SPY. Hit it, because that's the old resistance that we had. We'll hit it and then potentially bounce off of it and continue to now slowly grind higher to the upside, as we mentioned in yesterday's Market Outlook video. The momentum line's down, but it's not down to extreme low, so it's not a concern. The market sentiment line is starting to roll back over again. The intermediate line's up above. The longer it gets up above it, it brings it up, right? And you get below it, you bring it down. So now we're up above it, and there's opportunity for it to go up. Of course, we've got the dark green shading in the green line, and we are well above the moving average there. So here's the relative MACD, at least, down here at the bottom of the 8 and 17-day moving averages. You can see we're pretty bullish, but again, that's typical. When you're coming from low levels, you'll get a surge of volatility coming off of a low point on that first move off the low, and then you tend to just grind its way down. You can see over here we came off this intermediate low point. We got a surge in momentum, and then we just kind of grind it to the upside and diverge to the upside before we got more weakness. And so here's our surge off of this intermediate low point that we're currently getting, and it's relatively high here at almost 1 point. If I were to add a line here at 98477, so we'll just edit that and put it at 98477. Okay, you can kind of see there's not too many times we've been more bullish. Obviously, January 18 was an extreme bullishness. Coming off this low point, we were pretty bullish. So it's a similar pattern that we have coming up. You can see other coming off that intermediate low, and then we were grinding higher as it stayed up, coming off this intermediate low. So there's precedent for this, but just because we're this bullish doesn't mean necessarily that we're going to falter here. When you look at how far above the moving average we are, and the same principle applies. When you come up from below zero, you tend to get to high levels, and then you just grind your way down. and that's how we are now. We've gotten through the moving average. We've gotten up above the moving average on this nice surge from being below. And now we just will most likely maybe go up a little bit more here or there, but most likely grind our way down, up and down as we continue to push higher. Probably not, I mean, obviously not to that extent. It's a different market that we're in right now. But that's kind of the idea, something more like this probably over here. Taking a look at the others, you can see the Dow Jones, a little bit of an upper shadow here today, so it might be in for some short weakness, same bearish divergence pattern there. The NASDAQ, its intermediate line has gotten up above 80. Same thing above a rising moving average. And finally, your Russell 2000, its moving average is still dropping, so it's still going to be yellow again on Monday. It's the weakest one, but its intermediate line has finally crossed through its market sentiment and into the upper half of the chart. You do have an intermediate confirmation signal with the oversold momentum line. Its near-term line is already down below 50, a little bit weaker today. But as we've seen in the past, you'll see here coming up later in the video that small caps tend to underperform when the dollar goes down. At least the last few cycles of the dollar's been bearish. We'll pull that up here later in the video. But don't, it won't necessarily be at the end of the world if small cap stocks don't keep up with large cap stocks during any kind of dollar decline. All right, before we look at some other charts, we invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button, pops out. Or you can click the red subscribe button below the video if you're watching this on YouTube. Hit that bell next to it. That will notify you when these videos are posted. Also, hit that thumbs up icon down below the video. That tells us two things. Number one, you got something out of the video today. It also tells us, number two, that you want us to do it again Monday. So it's an easy way to give us feedback. If you like these videos, if you want us to keep doing it, the only way we know is that you're watching and that you're hitting that thumbs up. So we appreciate that. Join our daily market outlook email list. We have a link up there. You're going to want to be on that list because in the future, we're going to be posting the links to these videos just to members of our subscriber list for the full video. So make sure that you're on our email list to be able to get in the future as we evolve here the links to the full videos of our market outlook. And then finally, follow me on Twitter for more content. I put some stuff out there today. There's my handle up at the top of the screen, and then join our Market Outlook community that we've created on Facebook. Of course, the other way to make sure that you get the links to the full videos, which would include the trade idea that we always do at the end of each Market Outlook video. If you're watching this on our blog, right up to the right, you can join our website. That's where the full videos will be posted. They'll be posted here. And you'll also, if you click on this icon, it takes you to this page. Very easy way to do it. You can do it for free. You can also sign up for the email at the same time when you subscribe to the site. Or you can sign up, if you've already subscribed, you can come down here below and sign up for the email list there too. Just want to make sure that you're all able to get everything as we eventually evolve into having more of our Market Outlook video here at marketscholars.com. We also want you to engage with us on social media. We make it really easy for you having the Market Outlook tweet and Facebook post right here. Again, the more you engage with us on those platforms, the more the platforms will push you our content that we put out there from day to day to make sure that you're seeing it. So, you can click this heart that will like. You can like today's Market Outlook tweet there and then click this image. It takes you to a new window and you can like and share today's Market Outlook Facebook post there as well. And of course, here in our community, you can like it here. And of course, that there's a point system within our community that allows you to be able to kind of see who the active members are. And part of that is engaging with our content on our site as well. All right, back to the charts. Now let's take a look at the weekly chart. First of all, let's take a look at the weekly market forecast. I tend to forget to do that on these Fridays videos. But you can see the weekly market forecast here, how very close we were. Well, we did get a cluster here last week on the weekly chart, and then again, we're getting close this week of getting an overbought cluster, which is not a bad thing at the beginning of these runs like this. You can see dark green shading, dark green line. So the near-term line, which was so low on the weekly chart, and that was our signal that last week of May of being bearish. When it gets this low, it tends to in this case took one more week and then we bounced, it tends to be a pretty bullish pattern over multiple weeks, and that's what we're getting right now. Very good week there, and of course we're in the month of June, so we're in a monthly chart, and that momentum line that was so extremely low, you can see how, again, we still got another week in June left, but look how we just went right back up to the upside. So big time move and reversal of fortunes here, and you can see again dark green shading, dark green line, so pretty bullish there as well. Now let's take a look at the long-term moving averages, both rising. The 50 days up above the 200-day. If you take a look at the Hakenyashi candles, easily bullish candle. Most likely going to get another bullish candle next week because, again, the midpoint's going to be right around 28.88, and we're trading at 29.50. So we're going to start off next week with a pretty bullish candle. And as I mentioned before, this is the current level of the weekly price percentage oscillator. And you can see there's times when we get bullish that we spend a lot of time up above this level as we rise through this kind of 2.5 area. So a lot of good opportunity to be bullish here for a while. I mean, it doesn't mean that we won't have some ups and downs in the near term, but from a long-term perspective, we have technicals that are showing us some good opportunity. If you take a look at the 3 green arrow chart, obviously we have 3 green arrows and now a rising moving average. On the 2-line version of that chart, of course, the MACD is really high, but that's what happens when you're coming from deeper lows. You blow through the 0 level and you get up to a surge high, and then we start to slow down. We kind of followed the trend of the options market had priced in to the upside, a 1 standard deviation move. That's the green line. These other lines, this line right here is the duplicate of that bullish move. This line is a duplicate of the bullish move off of the December 24th low. So we've kind of had, a little, not as steep of a jump as we had here, but steeper than what coming off of that Christmas Eve low point. So a pretty decent move there. If you take a look, and of course on the Bollinger Bands, the most important thing here is the fact, let me get rid of some of these drawings so it's easier to see. But you can see the most important thing is that we are above, even with today's little drop, the value area. So we've cleared through the significant volume node this week, and so far holding on a little pullback. It's not even enough to get the near-term line down, but we're holding on a little pullback that support at the value area, the top of the value area. The Bollinger Bandwidth is starting to get relatively high, about 8.5. Just to kind of put that in some perspective here. There we go, 8.5. And if we were to go out, say like 5 years for some perspective sake, it has been more bullish. I mean, that January got more bullish than this. Both of these periods were down moves. Here was a bullish period in that 16. We looked at that before in other indicators. These are both down moves, and that was a down move. So, and then here's another one that we looked at before too, coming up that low point where we surged higher and then we just started to grind. So we're in that surge high right now on the Bollinger Bands, and we got the potential for it to slowly continue to grind its way higher. Of course, the orange line, excuse me, let's bring up SPX. The orange line is below 20, just barely has crossed. The blue line is up above. The ADX is rising above 20. So it's got the opportunity to make a run, right? Like last time it came off this intermediate low point, we rallied. The ADX rallied for a while as that gap stayed pretty big for a while. So we're just now starting to create that gap. So a lot of these indicators are telling us that we've got some good potential to continue to move forward to the upside. Maybe not to the same extent as we've seen some of these other moves, but we've got some pretty decent potential here. Okay, now let's look at the intraday chart, and you can see, just like yesterday where we had an upside gap and we filled it, it wasn't a breakaway gap, it was an upside gap, and this isn't a runaway gap. We're not starting to move to the downside, a new trend, and you can see that gap got filled too. So that's what happens. Gaps get filled unless they're one of those two kinds of gaps. And we rallied today and filled in the gap, and then we came down and closed near the low yesterday, but still an inside day, so more of a neutral day though. A little bit of a bearish bias because of how and where we closed. If you take a look at the volume, and the trading range that we had today. Here, let's go to SPY on this chart. You can see the range was really low, 1.76 points. A little bit of addition to the gap, so 295.86, the high at 295.52. So about 25 cents, roughly 30 cents or so of a gap to add to this. So we're about 2 points with an ATR of 3 points. So below average ATR. The volume was right about at the average, 83 million shares trading. So you see on where that stands here, 83 million is a little bit above this average here, and 2 points is down here. So again, that will help bring this line down, and that's your sign when we get below 1%, which 2 points is well below 1%. Then that's a good sign that we are maintaining now this new bullish posture. And the last thing I look at for that is the volatility index, and it did rise here at the end of the weekend. I think there's a little concern over what may come out over the weekend. Of course, the most important news will be next weekend, right, with the G20 summit and anything that can come out of that related to trade expectations. But of course, that's been kind of the thing with Friday. Even though markets may rally, volatility steps up a little bit whenever there's concern over what may come out over the weekend, whether even if it's just a tweet. So we did finish up. Again, it was also options expiration for all your June's futures and options contracts. So that quadruple witching today. So we'll see. Again, we have to break below 90% and hold that break for that train to leave the station, so to speak. And we're not quite there yet. Even if we do see, and when you look at the volatility chart, excuse me, it's going to be right here. The volatility chart, we got a couple 1% moves to the upside this week. That's strong, but we're not getting anything that's really exceeding the 1% very significantly. So we're starting to work our way back. You can see a very similar pattern when you're coming off this intermediate low point. We just start to really grind with very small moves, never exceeding the 1% mark. And that's kind of where we're at right now. All right, so to summarize the technical outlook here, we're bullish. We're continuing to have this bullish trend, this bullish posture. A little soft today. Doesn't really even change the near-term outlook yet. There will, at some point in time, be a near-term pullback. And we have an idea of where we're looking for any kind of pullback to get to and still be okay with the current posture. But we're getting closer to where the trend's established, and we can continue to expect, considering that we're probably a week or two into this intermediate run now, that it will last a typical 1 to 3 months expectation. So probably throughout the rest of this summer, through July and August, before we hit into September and October. And so that's what the technicals are showing, and they're progressively showing less volatility, smaller volumes, smaller ranges. And as we do continue to push higher, now that we've exceeded through like volume resistance levels, it's not going to be pretty. It's not going to be big moves day after day after day. It's going to be small, slow, especially with the summer on us, very boring moves. It'll be hard to trade long calls in that kind of environment because the market just doesn't move enough. It doesn't move fast enough. So keep that in mind. Premiums for vertical spreads might not be very much either, and if you are getting a lot of premium, there's probably going to be a reason why. So keep all those factors in mind as you're trading actively over the summer months. It can be harder because of the lack of movement and the slow grind that we could potentially get that we've seen in past summers. So what do you think with that assessment? Do you agree or disagree with that? So now's your chance to vote. Click that link right there in the top right corner of your screen. Opens up a poll. Hit either agree or disagree. Then if you click disagree, scroll down to the bottom and comment on what you're seeing that would suggest either that you're a lot more bullish than I am, that maybe you do think it's going to go up every single day here, or what are you seeing that suggests that we should be a lot more bearish than what we're seeing here on the charts. Let us know down there in the comment section below. All right, now let's jump into what's driving the price action today. And you can see we started off the week really bearish for developed markets. They were down here on Monday. You can see crude oil was down. They rallied by the end of the week, finished with a small gain where the U.S. stock market itself was up 2%. But the biggest winners this week were your anti-dollar trades. the dollar was your biggest loser. Bonds were flat. Preferred stock, even high yield, outperformed, which is actually a good sign of risk appetite. Emerging markets beat the stock market, the U.S. stock market, because of a big, strong 9% move in USO. So big gains in crude oil this week, really big gains. And of course, gold rallying too with the weakness in the dollar. I did want to point, again, for those of you who follow me on Twitter, I posted this earlier. Here's that chart I was telling you. So here are the last 3 times that the dollar index, DXY, has dropped 5% or more. Obviously, in 2014, we had this big 26% rally in the index that lasted about 9 months or so. But since that rally, we've had 3 pullbacks of 5% or more. One of them being a pretty long, almost a year plus pullback of 14%. So this first pullback right here of 7%, you can see how different asset classes performed. Emerging markets were up 12%. The stock market was up only 3%. Emerging markets did really well with that dollar weakness. Of course, gold was up 6%, beating stocks. Gold was up, and it wasn't a down market because, again, the dollar was down. You can see this is the ETF that is meant to track the dollar index was down 7.5%. Of course, long-term bonds were down too, despite the dollar, and yields were up despite the dollar weakness. But you can kind of see, even look at small caps underperforming during this period, barely up, less than 1%, while the stock market itself is up 3%. And then you look at the second move, about 7.5% decline on DXY, and you see, okay, not surprising to see gold was up over 20% on that decline, but a lot of weakness in crude oil held back the stock market. So the stock market finished that declining period with a flat gain, mainly because of the weakness. 14.5%, at one point in time down 35% drop in crude oil in early 2016. So that really weighed on the stock market. It really weighed on the emerging markets as well, because they're more linked to commodity prices like crude oil. But by the end of that period, you can see emerging markets had climbed back up and finished with a bigger gain than U.S. stocks did. And of course, foreign bonds did very well. They're not as impacted by crude oil prices. Long-term bonds actually did rally this time, which is more expected. The dollar is weaker. Yields tend to be weaker too. So, but again, look, small cap stocks lagging behind, down 5%. The stock market was flat. And then finally, this big, long year plus drop of 14% in the dollar. You can see here that emerging markets just killed it. So the stock market was up 20% over that time, and emerging markets beat it, doubled it, with a 40+% gain. And again, big time underperformance in small cap stocks, less than that, only about a 10% gain. And that all of that is with weakness in crude oil. And you can see again how bearish the dollar index, the ETF that tracks it. And you can see also too that foreign bonds are outperforming U.S. Treasuries, which was the case in all 3 charts. So you see some patterns developing every time the dollar makes a run. And I believe that the dollar is making a run towards a 5% pullback. We've seen in the past what that means. It's obviously bullish for gold. It's bullish for emerging market stocks. Even if crude oil is weak, it's bullish. It's more bullish for large cap stocks than it is small cap stocks. And of course, it's bullish for foreign bonds and gold prices as well. So those are the things that really benefit from the weakness in the dollar, and that would be expected to be the case again if we were to have a similar drop down towards 94, if not below. We're already down 2% of an expected, of any kind of 5% move that we might get. Looking at the foreign markets, they're all turning green. So you can see there the market forecast intermediate lines are rising. The green, they're all green on the back. The only ones that aren't above 50 yet is Germany. They don't have the green line either. UK, they don't have the green line either. Italy is just barely turning up higher. Those are the only 2 that aren't currently rising yet. Everything else, and you can see Russia continues really to take off there. And you can see too, like Brazil is getting back to new 3-month highs. Canada's flirting with new 3-month highs. all across the board. Really good potential returns. Remember, emerging markets are extremely undervalued relative to U.S. stocks. All right, so here's the relative strength chart, the relative rotation graph off of stock charts, and you can see the nice good week that emerging markets had here to break out and get above its 200-day moving average or 40-week exponential moving average, like the U.S. markets already have. You can see its momentum is still kind of stalled, pretty weak momentum there. This is on a weekly chart, mind you, so it takes a little bit longer to roll over. If I were to take a look at a daily chart, it looks a little different, right? You can see here the relative strength is actually turning up against the S&P 500. You've had some bullish momentum, and that's brought your relative strength from really low levels up to high levels on the daily chart. But going back to the weekly chart, you can see the relative strength is at some pretty decent lows down here towards 96 and still falling, but it's the momentum is close to turning up here. It's already crossed through, close to turning up, and as that turns up, it will bring it up, coming off of a higher low on the relative strength as well. You can see how it would start, and of course that period of time from late 2016 to early 2018 was a period of dollar weakness, and you can see the strength that emerging markets had during that period there. That would be the expectation. Maybe not to the same extent, but that kind of move you would expect to see going forward from here. And that would, again, as this relative strength line goes from low to high, that would mean that there's some pretty decent outperforming gains. Doesn't necessarily mean the U.S. stocks are falling. It just means that emerging markets will go up more. All right, now let's take a look at the sector rotation. You can see the S&P up here, and you've got some pretty decent return. Now, you're getting some weakness in the real estate. You see real estate staples down here at the bottom. Utilities wasn't down as much, but still lagged behind. In fact, the only things that actually gained the S&P today were communication services and healthcare. But you can see staples, despite the weakness, and for that matter, all these safe havens, are still well up above their moving averages, and their moving averages have been green for a lot longer than any of these others that are just barely turning up. All the rest of them are just barely turning up. All the intermediate lines are above 50. The energy sector is the only one that's got the weaker intermediate line, but still above 50, and doesn't have the green line yet. Materials and industrials would be your other dollar sensitive. Industrials has started. Materials has looked a lot more bullish here. It's been flattening out. But these three are the sectors that would do better in a weaker dollar environment. Remember, if yields stay pretty flat, then you'll see some relative weakness in financials as well, as you continue to see right now. That can also impact, staples and especially utilities and real estate, as they're interest rate sensitive, and the other direction. So if interest rates stay low, that will provide opportunities in these stocks for those high dividend payers, high dividend yielders, as well as certain industries within the communication services that act more like utilities. All right, today's trade idea focuses on what's been going on in the dollar. You can see the dollar really finished the week breaking below. This is actually the ETF. Let me bring up the dollar index first. You can see how it broke below that low point, its previous near-term low point. In fact, let's take a look at the market forecast for it. Which has been showing that the bearish combination. It had a brief semi-bullish, didn't have the dark green shading, but we're right back into this really weak short-term sentiment, bearish posture here that's strengthening to the downside. You can see it's down below the market sentiment, pulling the market sentiment lower. You break below this 96 level, the next layer of support is going to be at 95. You got another one right around 94, a little bit above it. And that's where the dollar index. That's the issue with the dollar index, and a lot of that's influenced by what's going on with yields. Yields did bounce up today after such a significant decline, but you can see what the weekly charts. In fact, the long lower shadow here suggests that there could be some opportunity for the breather to finally come in yield in the bond market. It doesn't necessarily mean that the dollar, as we saw TLT. There's during some of those dollar bullish at times, TLT actually rallied. The TLT fell and yields rallied. during the dollar decline. So especially considering that we've already declined so much, I wouldn't be surprised if we don't pull back up towards 2.5% on the 10-year note. And you can see, that weak dollars has impact on crude oil. It's had a nice, good week here this week, potentially bouncing back up. That's on the weekly chart. You can see the daily charts getting closer, showing that bullish pattern again. And then, of course, gold is really taking off, and it's got some, it's really gone up and getting a little bit of a long upper shadow. It's got a strong bullish posture. Its market sentiment line would tell you that it's not done, right? We might get a little pullbacks here and there, near-term pullbacks, but the market sentiment still got some, it hasn't crossed up above 50 yet. You look at the long-term charts for crude oil, and you see that, look at that breakout move. I mean, that's a significant breakout over the last 5 years. You have to go back more than that. Even all the way up to this level here. That's a significant breakout. Now, again, don't be surprised if we don't pull back to 1375, 1365 in this area in the short term. You can see the PPO isn't even close to being as bullish as it was during 2009, 10, 11. So it's not like we are so extended overbought here. In fact, it was more overbought here in 2016, heading into June of 2016. So we're not even close. Gold's got potential to run, and we had talked about that was actually one of the reasons why we've been bearish on the dollar, is because of the pattern, the bullish patterns of gold and the opportunity it has. After getting its golden cross, you have its test of the 200-day moving average, and it's rising. So this heavily influences our trade idea for the day today, which is in that energy sector, and it's in Schlumberger. You can see if you look at Schlumberger, it's got this big time bullish divergence on its long-term averages here. Big bullish move here this week. You can see what it looks like on its market forecast chart. It's not quite bullish yet. You don't have almost have the dark green shading there. You just barely have a yellow line, so we're not quite green on that, and that's going to show on the 3 green arrow chart as well. You do have 3 green arrows here, and you did have a pretty decent amount of volume today, almost at 1.5 times the average, but you don't have that green line yet. Let's look at the 3-line chart of this looks like. You can see it's been very bullish. Again, when it makes its way through zero, it doesn't just pitter-patter here. It can. But if we're changing the trend, it's going to make a surge, right? Surge and then grind its way down, and we'll watch to see. When it pitter-patters here, the orange line doesn't get above zero, at least significantly. So we'll watch that orange line to see if it gets through that level, that zero level. And you can see the 8 and 17 day are really close to crossing above the 30-day moving average as well, which would be a bullish sign. You look at its Bollinger Bands. And the Bollinger Bands, we kind of held support at the lower end of the value area. We're now moving our way through this kind of vacuum towards 44.5. That's where your next layer of significant resistance will be. That's, we're at 38.88 here. 44.5 is our target. Now to the upside, you look at its DMI, and you see here that its DMI chart, be nice to actually type in the right symbol, has got that combination that we want. Now it's got a falling ADX because we're coming down from this bearish posture, but you see how it's flipped now. The bulls are above 25, the bears are below 20. That's the combination that you want to see when we're switching the trend, as we saw over here when we went from bullish back to bearish. That's a nice, good pattern. So it's got an emerging bullish pattern here. It's got some significant overhead supply and resistance. So let's say, let's do a long call vertical spread where we buy at the money. It's only a 4-week trade. You sell this 42.5 for really cheap. So it's got a very low delta because it's not dollar wide strikes. It's a $2.5 wide strike. So you end up with a pretty decent reward to risk ratio as it is at full maximum gain. Now you most likely won't take the full. You're most likely going to end up taking about half of that at the worst. So about $35 loss for a $180 gain. Now, granted, we won't position size around the full $180, the full, that 50%. We're going to position size around the full maximum loss. Since this is relatively aggressive, we'll just go for the smaller, kind of a half position, knowing that I'll take even less than that if it did go against me. But my reward, if we were to get up to 44.5, would be a $1,400 gain for a $250 risk that ultimately we'd take if it doesn't work out. So decent reward to risk ratio on this trade that you can do a nice little setup for. All right, and as always, that does this for today. I appreciate you watching. Now I want to hear from you. Use that link that's popping out right there. It takes you to our forums at marketscholars.com. You'll be able to open up any new thread you want with any questions or comments, and then reply to anybody else's threads as well if you have any thoughts of your own. Let's keep this conversation going in between videos here and over the weekend. As always, thank you very much for watching. Have a great rest of your weekend. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow us on Twitter for more content in between videos, and join our community on marketscholars.com as well as the one that we created on Facebook. Remember, Market Scholars Premium subscribers, we have our Q&A session early tomorrow morning. So if we see you there, we'll see everybody there. Otherwise, have a great weekend, and we'll see you all next time.